Now, there are lots of financial challenges for young people these days. Getting through university, earning a decent living, buying a house, starting a family, or even having enough money for later life. So that's why it makes sense to build some savings for your children so that you can help them not do nothing, but enough to do anything. Now, when it comes to saving for children, start early, start small, and get better later. I'm Jason Butler, and I'm a fully qualified personal finance expert. I'm a chartered fellow of the Personal Finance Society, and I've had 30 years of advising other people on their money and also building my own wealth. If you like this video, please make sure that you like and subscribe so you never miss a future episode. Now, there are 3 key factors which will influence how you save and invest money on behalf of children. The time horizon and the amount of access that you need, the amount that you're saving and investing, and the frequency, and the risk-reward profile that makes sense to you. Now, as you can see from the chart on the screen, risk and reward are related. As a general rule, cash is not a great store of value over the long run, and that's because it devalues relative to inflation. Bonds tend to give a slightly better return than cash, but they can also be volatile in the short term if interest rates rise. And equities have traditionally provided the highest return, but they're also the most volatile. So what that means is if your time horizon is less than 5 years and or you need access to your money at any time, then probably cash is a good home for you because inflation is less of an issue, but the capital security is more important to you. If your time horizon is 5 to 10 years, then you could probably look at cash and bonds because bonds will hopefully give you a slightly higher return than cash and you can ride out those fluctuations in the short term. If your time horizon is 10 years or more, then you can probably look at bonds and a fair allocation to global equities. And that enables you to ride out any short-term fluctuations or even indeed stock market crashes that do happen from time to time. Now, when it comes to cash, you've got 3 basic options. You've got the traditional piggy bank, like my daughter Megan's here, where you can put money in, take money out. This is a great way for them to, and this is really great to help children learn about the value of money because you can put notes in, coins in, and it's just a real great way to help them physically get involved with saving. So the second option is an instant access savings account. Doesn't tend to pay huge amounts of interest, but it pays something. And if it's a special children's account, which there are many available, it normally pays a bit more than a normal account. And you normally open that account as the parent or grandparent and hold it as a bare trustee. You can also do regular savings accounts. These tend to pay a little bit more than instant access, but the only downside is you have to make the payments normally for at least a 12-month period. Some accounts do allow variation, but regular savers will generally pay a little bit more interest than instant access. Now, as I mentioned, normal savings accounts for children are opened by an adult as a bare trustee, which means that you control the account while they're under 18, but they get the rights to the money as their own asset immediately they turn 18. So the good news is you can control it while they're young. The bad news is they'll end up with that money absolutely at 18. Now, there's one tax issue which you need to be aware of if you're a parent giving money to your children and putting it in a savings account. And that's if the savings account generates more than £100 interest from capital which a child has received from its parent, then that money will be taxed as if it's the parents. Now, if there's a couple or a husband and wife or a civil partnership and you've given money to your children, that means you can have up to £200 annual interest if you've jointly given the money to your child before it gets taxed against you. That doesn't apply if you're a grandparent or anyone else who's given money to a child that they put in a savings account. And the same arises if you have interest from bonds, which we'll touch on in a minute. Now, one way to avoid tax completely, including that tax on parents, is by putting the cash into a junior individual savings account, a JISA. Now, you can invest up to £9,000 per annum on behalf of a child, and it's completely tax-free, and the interest is tax-free completely. And as I say, there is no tax on parents if they've given that capital to their child. Now, 16 and 17-year-olds can also invest up to £20,000 into a cash ISA on top of the £9,000 that they put in a junior ISA. So for 16 and 17-year-olds, that's up to £29,000 that they can put into a junior ISA and a normal ISA. Now, staying with cash, another option is national savings and investments premium bonds. You can invest from anything from £25 up to £50,000 on behalf of a child. They don't get interest, but they participate in prize draw every month, which could be anything from £25 prizes all the way up to 2 prizes of £1 million. And those prizes can be paid out or reinvested. Now, whether you get more or less than you would have got from a savings account, who knows? But the fun of potentially winning big prizes makes it very attractive for lots of people for the low risk portion of capital that you're building up for your children. And the good news is, if you do need to get your hands on your money, you can normally get the money back from National Savings normally within 2 to 3 days. Now, moving up the risk reward scale is bonds. Normally you would invest in a bond fund, or you can buy individual gilts. But this is where you receive interest, and as long as you hold the bond to the end, you get your capital back. But if you buy a bond fund, what happens is you normally expect it to produce a higher level of interest over the medium term than holding cash, but in the short term, the bond value can fall and rise. So if interest rates rise, the capital value of bonds will fall. If interest rates fall, the capital value of bonds will go up. But over the long term, you would expect the return on bonds to be somewhere between the return on cash and the return on equities. You can hold bond funds within a junior ISA and they're completely tax-free. And that makes sense if you're doing that as part of a diversified portfolio. Now, moving up the risk reward scale, we've got global equities. Now, you might want to look at my previous video on the Global Equity Index Fund to tell you a bit more about how that works. But essentially, buying a small amount of thousands of companies all around the world that produce profits and provide services makes sense for that portion of your child's capital that's going to be for at least 10 years or more. So if your child's very young and you're thinking 18 years plus, then making sure that you're regularly investing into global equities is probably a good idea for a larger proportion of your money. If your child's older and they're going to need the money in a shorter period of time, as I've said, probably not a good idea to be putting money into equities, because you need to have at least a 10-year view. Now, one of the simplest ways of holding equities is through an equity index fund, which I've mentioned before. And you can either invest that money on behalf of the child as a bare trustee, which means you are holding it for them, in which case, if you make capital gains on behalf of the child, they will fall within your child's capital gains tax allowance, which is currently £12,300. Now, one of the simplest ways of avoiding any capital gains completely is by holding global equities within a junior ISA. So whether it's cash, bonds or shares, that falls within the £9,000 per annum that you can invest. So you could put all of your £9,000 junior ISA into global equities, or you could put a proportion. And what many people do is use one of these multi-asset funds that holds some bonds and some equities, and then they hold their cash elsewhere in a savings account. Now, because global equities are volatile, they go up and down, this actually works in your favor if you're saving regularly on a monthly or quarterly or even yearly basis, because over time, as the unit values fluctuate, you should end up paying on average less than the average unit price over that time. That's called pounds cost or dollar cost or euro cost averaging. Now, as I say, you can put up to £9,000 into a junior ISA, and when the child becomes 18, they get the rights to that money absolutely. So make sure that you're having conversations with your children about what they're going to do with that money as they get nearer to 18. What you could, of course, do is just put the money that you were going to put into a junior ISA into your own ISA allowance, which is £20,000 a year, if you want more control, if you might want to use the money yourself, or if you're a bit worried about your child receiving that money absolutely at the age of 18. Now, another way of holding global equities, and probably one which makes the most sense if you're going to take a really long-term view, is to invest on behalf of your child through their own pension. Now, you can invest up to £2,880 on behalf of a child into a personal pension, and the government will add £720 bonus, even though your child pays no income tax. Now, they can't touch the money until at least 57, which is what we're expecting the earliest retirement age to go up to by the time they get there, and it may even be a bit later than that. And they can only access a quarter of that money as tax-free cash, and the rest of it they have to take out as taxable income, but it can be taken as a lump sum. So investing a small amount into your child's pension might make sense if you've already maxed out your junior ISA, or you're looking for additional ways of avoiding them getting their hands on their money too soon. But just be careful about pensions, because it does restrict your child's flexibility, and they may have needs for that cash earlier on in their life. And just one thing to say is, if you're investing money through a junior ISA or a pension or bonds or equities, you can vary the providers, you can vary the funds from year to year. So you could use one provider for the wrapper, the junior ISA or the pension, and change the funds from year to year. Or you can change providers if you're, for instance, having a junior ISA in cash one year and then you're going to have a bonds or equity. So you don't have to stick with one provider. But for most people, they're probably going to want to keep one provider for the pension pension and one provider for the junior ISA, and possibly move the savings account from year to year. Now, one other option which I should mention, which doesn't get lots of news, is what we call friendly society plans. Now, these are savings policies provided by friendly societies, a type of mutual company. And what they do is they normally invest the money in a broad range of investments. Sometimes it can fluctuate, sometimes it can be smooth, and you can put up to £270 per annum in one of these, and it has to run for at least 10 years, and the child normally gets the rights to it from the age of 16. The only downside with friendly society plans is they tend to be a little bit more expensive than a global equity index fund. So just watch that one, but it's well worth looking at, and particularly if there's smaller amounts of money that perhaps other members of the family might want to put aside for your children. So with children's savings, the message is start early, start small, get better later. But you know, the most important thing you can do for your children is to be a good financial role model, because children learn from what they see other people doing with their money, and none more so than their parents or their grandparents or their other relatives that are close to them. Now, I mentioned pensions earlier as a possible route to saving for your children, so you might want to check out my other video all about pensions.